Hey there, everyone. Happy Monday, February 10th. I'm Dave Keller here with Market Misbehavior, and welcome to Chart This with Dave Keller. It's Monday, February 10th, 2025, and we're saying hello from a kind of beautifully overcast and still kind of snowy and chilly Redmond, Washington. Hope you guys are doing well, staying warm, and hanging in there wherever you're at. Congrats to the Philadelphia Eagles, dominating in a very Ohio State Buckeyes-like way their opponents in the Super Bowl. I do have some Eagles fans in my network. I have sent some congratulations around. I probably didn't get around to everyone, but if you're a fan, I congratulate you for sure. Looking at the market conditions today, kind of a nice, decent update, strong way to start the week, particularly after the weakness that we saw on Friday. We did our all mailbag episode on Friday, and if you missed that one, I would make sure you watch that. A lot of fun to answer some of the questions that have come in from all of you in recent days and weeks. But we talked a little bit about the weakness being demonstrated on Friday's session. The Hindenburg Omen, which I did get some questions about on Friday's episode, did not trigger by my assessment. I'll share with you the chart of the Hindenburg Omen, why that's not the case, but how also conditions, I would say, still very similar to Hindenburg Omen conditions. It was very, very close. It's a little technicality that prevented it from doing so. By the way, I can see questions you put in on any of the platforms upon which we are live streaming right now. We're on Facebook, LinkedIn, YouTube, and X. I appreciate you so much tuning in live. And if you have the ability to ask questions as we go. Anywhere where you can put a comment on any of those platforms, I can see them as we're doing the live stream. And I'll try to take a question or two at the end of today's episode. Anything we don't get to, we will put in the mailbag. We're planning an all mailbag episode on Friday of this week. And we'll hope to answer one of your questions in that next mailbag show. With that in mind, let's get to the markets today and how things played off. As I mentioned, kind of decent update, right? And we'll see that as evidence from the major averages as we go through some of the charts. I don't think a ton of change from what we were observing, last Thursday, Friday on the show. That overall, I say this is still a market in transition. You'll see that just in terms of the sectors that were up today. It's kind of a mishmash of value, growth, and defensive sectors, all kind of mashed up into one top of the leaderboard. With that in mind, S&P up 2/3%. Did finish today around 60.66. NASDAQ Composite even better, up 1%. The NASDAQ 100, so those mega cap growth stocks, were up about 1.25%. The VIX continuing to tell you, move along. There's nothing to see here. The VIX below 16 as of today's close. That's down from around 16.5 on Friday. So we're below 16 with a 15 handle. That basically says low volatility. In a low volatility environment, I'm basically looking for a spike in the VIX, a spike above 20. And while that doesn't necessarily mean the end of the world, it definitely would mean a change of character in the volatility conditions, and basically suggesting that investors are getting nervous. Elevated volatility means elevated uncertainty, means elevated fear, which means elevated chance of the markets going lower. Not happening so far, and the VIX has actually remained fairly muted so far in the early days here of 2025. Looking at the interest rate environment, kind of a flat day. I mean, no real significant shifts around here. The general trend has been, rates sort of the 10-year. So Lord, I'm all over the place. The TLT, which is a bond ETF, we've noted how we've sort of been bouncing off of potential support here, maybe beginning that next leg higher, which would imply rates coming down a bit. Well, remains to be seen, though. For now, kind of holding support. The 10-year yield ended the day right around 4.5%. That's pretty much where we were on Friday's close. Not much of a change, although rates did come down earlier in the day. Long bond yield slightly higher, but again, not by much. And the TLT was down just about 1/3% lower. Watch the dollar as always. Dollar kind of trended steadily higher today, although not a significant move. This was sort of a quieter day, I would say, in terms of general market movements, with the dollar index up about 1/3% from Friday's close. All green on the commodities page, though. You can see gold up another 1.7%. That puts the GLD around 268 and change. Silver, copper prices all in the green. Even energy prices, so crude oil, natural gas, all moving to the upside. Energy ended up being the top performer out of the 11 S&P sectors today. We've been generally steering away from energy in our work, mainly, number one, just because the relative strength's not there. There are other areas of the market that have continued to be, more impressive on a relative basis. A while ago, it was all the growth sectors. More recently, it's things like financials, sort of, emerging as a new area of strength. Energy's not been there, and arguably crude oil prices have not been strong enough to make energy a decent play here. We'll see. Days like today make me think I need to monitor that just for the right opportunities. Looking at the cryptocurrency space, I mean, Bitcoin sort of spending the weekend below 100,000 on Sunday. You can see we actually tagged that 100K level before coming down. I personally do not swing trade cryptocurrencies, but if I did, I might just be watching for when it tags 100,000, because that has tended to be a really consistent pivot point, meaning resistance if we trade up to it, below support if we trade down to it from above. For now, Bitcoin sort of sitting in the 97,000-ish range. A far cry of sorts from the 108,000 plus that we saw not too long ago, sort of the upper end of the range. I did grab a chart of Bitcoin just to sort of make some sort of higher level technical observations. I think, Bitcoin, similar to semiconductors, similar to major stock indexes, we're consolidating, right? We're sort of in that sideways range. And I think with something like Bitcoin, you'll see a clear kind of rectangle on the chart, kind of a basing pattern. And that type of pattern tells you two things. Number one, if you can play swings, have at it, because we have a clearly defined range. We have clear resistance, clear support. So a very clear technical structure with which to, understand the movements that are happening on the short term and maybe bet on mean reversion, but also some longer term takeaways in terms of what levels would be breached on the upside or the downside that would tell us that there's maybe something new, some new information to deal with. For now, Bitcoin, other cryptocurrencies, for the most part, slightly higher during the equity trading session. A lot of those gains came earlier, though, and through the equity trading session, kind of drifted lower, particularly with the chart of Bitcoin. Looking at the 11 S&P sectors, we can see that 9 out of the 11 finished in the green. So, in terms of sector breadth, pretty good. Energy, number one, up 2.2%. Technology, number two, the XLK was up 1.5%. Utilities, number three, up 1.1%. I traditionally have thought of utilities as a pure defensive sector because utilities are pretty boring. The idea of generating power to fuel your homes and businesses is not a sexy kind of growth area until last year, when all of a sudden we're talking about the growth prospects for utilities, trying to provide all the power necessary to do AI and crypto mining and all those things that have been relatively recent technological developments that require a ton of power. So utilities kind of moving up along with technology today. On the downside, only 2 of the 11 S&P sectors were in the red. Financials, which has been one of the better performers on a relative basis in 2025, giving back some of those gains today, down 0.8%. Healthcare was essentially flat from Friday, down slightly, about 0.1%. And real estate was number 3 from the bottom, up slightly from Friday's close. One of the things I always look for, by the way, when I'm looking at this list of 11 sectors, and again, every day I look at this, I look at the order to see what's working and what's not. And I will tell you, one thing you want to hesitate or be careful about is not to draw too many long-term conclusions from this particular table. This is just showing you today's trading, right? So it does not mean that energy is the best place to be and financials are a horrible place to be. It means for one day, that is the particular movements that you've seen, but trends don't happen in one day. Certainly on the time frame, I'm thinking about trends evolve over days and weeks, if not months and years at times. So, again, understanding the short-term nature of this table is important, but I always look at consumer staples and consumer discretionary. And this comes from a traditional technique of looking at offense over defense, right? Things you want versus things you need, consumer discretionary versus consumer staples. And we can look at the XLY and the XLP. I like to look at the equal weighted versions of those ETFs as well. I did grab that chart to show you during our chart review, mainly because there's a bit of a disagreement. The cap weighted version, looking at literally these two, the XLY and the XLP, has actually started to favor consumer staples. And I would argue a big part of that is because some of the biggest consumer discretionary names, like a Tesla, which is one of the 3 biggest weights in the XLY, is feeling quite a bit of pain. Amazon coming off after earnings earlier, not helping as well. And so you've got some of the larger names pulling back a bit. The equal weighted version actually still favoring offense over defense. And I'll show you the chart and talk a little bit more about what those conclusions might mean for us a little later in the show as we get to the chart review. All right, looking at the breadth conditions, you can see advancers over decliners for most of these, particularly for the S&P large cap index, you can see is about 57% up, 43% down. On the broader NYSE, about the same, 58% up, less than 40% down. So this was definitely one of those days where more stocks up than down, although in something like mid caps, that was slightly reversed. But generally on the universes that makes the most sense, that I follow the closest, certainly up over down was the story today. Looking at the Magnificent Seven and Friends, these are some of the leading growth names, leading mega cap growth names. Let's see what happened here. NVIDIA actually up almost 3% today, and that's important because the chart of NVIDIA has been pretty underwhelming, right? You had the gap lower after the DeepSeek AI news, now a couple of weeks ago. And now we're starting to get back into that trading range that we were in before that gap, right? Remember, we came in on Monday, the news had hit over the weekend. Monday, NVIDIA gapping down, all the other semiconductors gapping down, sort of this big about the whole AI theme. Since then, though, we haven't had any further deterioration on a lot of those names. And to the contrary, we're actually seeing NVIDIA get back up to fill that gap that was created on that DeepSeek day. At least it's getting above the lower end of the gap. It's back within that gap's range. Amazon, which has struggled a bit as of late, popping higher, 1.7%, we'll call it. Netflix up 1.4%. On the downside, Tesla is the only one that was down today, down another 3%. Chart of Tesla starting to be a real negative outlier, although a number of these are not looking particularly strong on the short term. Apple, another one, essentially flat from Friday's close, but certainly has been, back on its heels when you look at the short-term structure. All right, that's the overall configuration to what happened today. Let's look a little deeper using a heat map here and focus on what sort of trends and themes we can find today. As a reminder, I can't see some of the questions coming in. I do see some questions on gold. We'll certainly should be able to get to that at the end of the episode. Other questions that come up, make sure you pop them in the comment section. We'll grab one or two at the end of the broadcast. And anything we don't get to, we will throw in the mailbag, which has been, again, a real pleasure to answer on Friday afternoons. So observations looking here. I mean, number one, I'm struck by financials, being, it seems certainly a negative outlier today. Financials, if you look year to date in 2025, banks have been, they've been the juice. You have JP Morgan, Citigroup making new all-time highs in 2025. In terms of relative performance, I don't know if anything's done better than financials, and if not, if not, it's got to be number two because it's been one of the better places to be today. Though, giving back some of those gains, and I'm struck by SYF as one of the examples popping up here as one of the worst performers. Synchrony Financial is one of those stocks I've grabbed a lot recently as an example of a bearish momentum divergence. If you look at the highs in November, December, and January, Synchrony has been making new highs in each of those months, but on weaker momentum. So every time we're making a new high every month, the RSI has actually been trending downwards. And while SYF is still, I would argue, in a primary uptrend of higher highs and higher lows, that divergence is a big red flag for me. That's what often happens at the end of a bullish phase, toward the exhaustion point, where the prices are still going higher, but on weaker momentum. And why that's important is because in a healthy bullish phase, you have increasing momentum, right? You see a stock breaking out and it's often overbought. You'll see a lot of influx of buying, which causes positive momentum, which sort of fuels the next leg higher. And that kind of works until it doesn't. And in the later stages, like eighth or ninth inning of a bull run, you see the price still kind of drifting higher, but the momentum starts to evaporate. And that's what we've seen on not just SYF, but a lot of charts in November, December, and January, which is one of those things that's certainly in the back of my mind as I'm evaluating technical conditions here in February of 25. Just all these divergences that I'm seeing. And it's so common at major tops. So while the market overall has not sold off a ton in 2025 at all, I mean, at worst, it's kind of consolidating. If you look at the major averages, those are the kind of things that are sort of in the back of my mind, wondering how much we'll be able to really, create meaningful upside beyond what we've seen, unless we start to see improving momentum. And SYF coming off today sort of continues to push that trade of higher highs on weaker momentum, which is not ideal. Also struck by a lot of the strength in technology, right? Obviously, NVIDIA up, and this has been, one of the biggest question marks because you had the gap because of the DeepSeek AI. NVIDIA was one of the biggest, drops as a result of that news. From that day, though, we never went much further, and I think that down day on that Monday has kind of been it. We've been trading around support, have not been going lower, and now all of a sudden you're getting to the lower end of that gap that we experienced. I did grab the chart of NVIDIA. We'll dig into a little further, but look elsewhere in technology: Adobe, AMD, Amphenol, Intel, Broadcom, Micron. These stocks, Western Dig, these stocks are all up, 5-ish plus percent, 4 or 5% or so. I mean, these are strong up moves to start the week, which is certainly an encouraging beginning to the week. Elsewhere, certainly struck by the strength in energy, right? I mean, I think one of the themes that we've been observing has been strong financials, weaker energy. Today, kind of the opposite, where financials leading the way lower, energy actually popping higher, and Exxon and Chevron both up about 2%, but it's sort of the other S&P names that are up much further. I mean, from a technical perspective, I still think that's a tough ask to be buying energy unless you're betting on oil prices going up a lot further. And the technical setup on oil has not been great yet. It's sort of been languishing, unable to get above resistance. But a day like today reminds me to watch those charts and look for improving relative strength for sure. Last thing I would point out is in a couple of these sectors, particularly healthcare, I'm also looking at consumer discretionary, kind of a very mixed results, right? You kind of have some extremes of, like in discretionary, for example, McDonald's, Nike, both up 3 to 5%. On the downside, you have Tesla, Norwegian Cruise Lines down 3% as well. Within healthcare, you've got names like Abbott, Cigna, Intuitive Surgical, all kind of having nice starts to the week. But then you have Thermo Fisher, you've got Bio-Techne, you've got Insight, all having some pretty big downside moves today. So what's interesting about healthcare and discretionary, they're actually quite diverse sectors, right? So there's a lot of different businesses, a lot of different themes at work in those sectors because they're it's a very very diverse group, right? A lot of different businesses are within those two different buckets of sector designations, I guess. So overall, this is it looks like more of a stock picking opportunity, right? Looking for individual names and themes that are having moves within those overall sectors. Those are sort of my observations looking at the market carpet on stock charts. And again, I'm such a huge fan of this. I know in my time at Fidelity, with the Fidelity chart room, we really worked at large scale versions of this type of visualization, trying to identify ways to demonstrate the overall performance of a benchmark. And allowing you to draw some big picture takeaways, literally take a step back from your monitor and see what stands out to you, but then also being able to get granular and being able to zoom in and be able to dig into particular opportunities, but understand the relative performance of those things and really allowing you to focus on outliers. Huge fan of that kind of visualization. I hope you're able to spend some time with that as well. All right, let's get to the chart review portion of the show. Here we're going to go through the S&P 500 and a bunch of other charts. I grabbed some macro charts, some individual stocks, kind of a little of everything to kick us off here on Monday. Looking forward through the week, we're kind of through the bulk of earnings season. There's some random names reporting through the week, but I think the big story, again, barring some, random thing that comes up, which if there's one thing I've learned in 2025, random things can definitely come up. I was waiting if there would be some DeepSeek kind of moment here on Monday. Didn't really see it. But I would say inflation data coming out on Wednesday and Thursday of the CPI and PPI. On Friday, we had our latest sort of run-in with jobs data / inflation, those things that the Fed Open Market Committee would be looking at as they are thinking about what they will be doing at the next couple Fed meetings. And I think Wednesday, Thursday had inflation data, particularly with tariffs coming out pretty regularly now, or at least the specter of additional tariffs and potential inflationary consequences to those top of mind for a lot of investors. So certainly those could be some key things to watch. So for today, you have a bit. I mean, I guess you'd call this a bullish inside day. Although that's not a great pattern. I don't even know why I'd mention that. It's not super common and not super meaningful. But you basically had a down day on Friday. This wasn't kind of a perfect bearish engulfing pattern on the S&P 500, but certainly weak, and we closed at the weaker area of the range on Friday. Today, we opened back in the middle of Friday's range. We traded higher, but really didn't get out of that range. So, we've spent the last couple of weeks essentially in that gap range that we established in late February. It was kind of right in the sweet spot of that, right kind of in that 60-50 sort of level. For me, this basically speaks to a market, excuse me, in wait and see mode. I think this is a chart that looks pretty significantly meaningful. I mean, I think there's a trigger if we can push above 6,100 and establish a foothold above that resistance level, because it served as resistance a number of times here in the last month. On the downside, I would say 58.50 is still that line in the sand for me. And as I mentioned before, and I would reiterate again, I think anything above 58.50 at this point is more noise than anything. I think you assume that the larger trend is up until 58.50 is violated, because what that would mean is we've established an equilibrium kind of consolidation range, and now that's broken. That's why we were very concerned here in early January. But again, we didn't really follow through. We immediately saw some buying power enter in the market. We ended up gapping up to 5,900 and continued up to 6,100. So for now, I would say this line in the sand is still valid. 58.50 is the level I'm watching. For now, we're sort of, treading water. We're holding in a holding pattern, waiting for further direction from ATC, and we'll see what happens. I did get some questions, by the way, on my YouTube channel on Friday about the Hindenburg Omen. This is a broad market indicator that I bring it up when it signals, because it doesn't signal often, but when it does, I've learned not to ignore it. We had the most recent valid sell signal in mid-December, and that's when you had multiple firings of the Hindenburg Omen within 1 month. And we had one in November, and we had another one in December. That's a valid Hindenburg Omen sell signal. The last time we had a sell signal from the indicator was in January of 2022, and before that, it was back here in 2020, basically going into the COVID peak. So kind of concerning when we have the Hindenburg Omen fly again. Now, as a reminder, there are 3 pieces to the Hindenburg Omen. Number one, the market needs to be an uptrend, and that is defined by the New York Composite Index higher than it was 50 days ago. And we can do that by measuring an indicator called the rate of change and just looking at a 50-day look-back period. Are we higher than we were 50 days ago? This, by the way, is what killed the Hindenburg Omen signal on Friday. Because we've had this kind of choppy sideways move, because the market has kind of been sideways here recently, the New York Composite Index is actually down from last Friday to 50 days prior. So the primary uptrend, which is the first sort of initial observation you're looking for, was no longer valid. As a result, even though the other things did fire, that wasn't true, and so the Hindenburg Omen was not completed. We did get at least 2.5% of stocks in the NYSE making new highs and new lows on the same day. That did happen on Friday. The McClellan oscillator did break below zero on Friday's session, so those 2 things were actually checked just fine. But because the market's been so sideways, it technically was not a signal. Now, I would argue, I mean, I'm not hanging on this indicator looking for another sell signal, thinking that that's going to be a big incremental additional data point. In my opinion, the fact that it's fired is kind of, the Hindenburg Omen has now done its thing. It's suggesting that surge in December was kind of the later stages of the bull phase, and now we are just looking for the breakdown. And I would say S&P 5850 is the level. Until and unless we break below there, we're just not getting the breakdown that the Hindenburg Omen basically indicated was a likely scenario as of mid-late December. So for now, still TBD. What you have to remember on the Hindenburg Omen, these are not timing signals, meaning when the Hindenburg Omen fires, it rarely means that next day we have a huge sell-off. It's not like a predict the Black Monday kind of indicator. It's more longer term. And so when you have a sell signal, it tells you start looking for breakdown signals. That's why we've been doing so since mid-late December. So that's the story as to why the Hindenburg moment did not technically fire, but again, overall, why I still see it as fairly negative after the developments in mid-late December. When we're looking at the S&P 500, as I mentioned, at least 2.5% of the S&P did make, or of the New York Stock Exchange did make a new high and a new low on Friday. So I did want to grab this chart looking, excuse me, at the net difference between stocks making new highs and new lows on the New York Stock Exchange. The actual common stock only names making new highs in green and new lows in red, and then the same thing for the S&P 500. I wanted to show you this chart just to show you one of the things the Hindenburg moment looks for is a meaningful number of stocks making new highs and new lows on the same day. That was a key factor that the creator of the indicator or the discoverer of the indicator found was common at market tops. And I just wanted to point out that you are seeing that particular configuration very much playing out here in early February. We have plenty of stocks still making new 52-week highs. For example, today you had 22 out of the 500 S&P members. So, what is that? 4%, 4 to 4.5% of the S&P making a new 52-week high today. But you also had 16 stocks in the S&P making a new 52-week low. So that's what 3.5% of the S&P making a new 52-week low. So you're getting stocks that are continuing to break out. We're also getting some stocks breaking down. So that very much is a market in indecision where it's not like everything's going up and nothing's breaking down, or everything's going down and just a couple of things are breaking up. This is one of those where you've got plenty of stocks doing plenty of things. And I think we saw that a little bit on the heat map, actually seeing plenty of green, plenty of red on a day like today. I did want to point out the bullish percent index on Friday for the NASDAQ did break above 70%, which is our normal kind of sell range. When the bullish percent index gets above 70% or below 30%, that's an extreme reading. And for me, extreme breadth readings immediately make me think like a contrarian and start to look for signs that that is dissipated. I'm highlighting that today because it happened, and I want you to be aware of it. I've highlighted in red over the last 2 years every time that we've seen that particular situation where the bullish percent index on the NASDAQ 100 has gone above 70%. You can see a number of times that actually has led to a brief pullback soon after, but not always. And that's why I hesitate a little bit. Like mid-November of 23, we went above 70%. Now, what was different here is we stayed above 70% for months. But when we finally came back below that level in February of 24, the market continued higher. That was one of those periods where the Magnificent Seven stocks were so strong, even though a bunch of other things started to sell off, those mega cap growth names, excuse me, were strong enough to actually keep the entire market averages continuing to push higher. So for what it's worth, that did generate a signal. The bullish percent index on the S&P, which is the main one that I follow, is currently down around 56 to 58%. So a big gap right now in terms of the percent of NASDAQ names in primary uptrends versus the S&P names in primary uptrends using the point and figure methodology. So something to look for, that we did get that extreme reading. It did not really continue much into the overbought area, which could mean we get a pullback here led by some growth names, but we'll see. I mentioned earlier when we were looking at the sector returns today, this particular view of offense over defense. The top panel is showing you the relative performance of the XLY versus the XLP. We can see that that ratio started to turn lower over the last month. Now, the problem here is this is a cap-weighted ETF versus another cap-weighted ETF, and the XLY is dominated by 3 stocks: Tesla, Amazon, and Home Depot, which means if any of those names are struggling in the short term, the ratio is probably going to turn down, if nothing else, because of those particular names. And I think that's what's happening here. Tesla, Amazon struggling over the last week or two. As a result, the ratio coming down. The equal weighted version of that ratio still very much favoring offense over defense. I would keep an eye on this chart for sure. For now, it looks like offense still outperforming defense using the equal weighted version, which are the preferred methods that I like to use. Here's the TLT. I mentioned the rally into resistance. You can see a trend line using the September 24 peak, and the December 24 peak lines up pretty well with the high that we established over the last week. So we're seeing lower highs and lower lows. We're at the upper end of that downtrend channel. The RSI for now appearing to stall out as it tries to get above 60. So this may be setting up for that next leg lower in bond prices, which would most likely coincide with the next leg higher in interest rates. We've talked about the longer term theme of higher rates higher for longer, which I think will most likely be what 2025 is our experience is probably like. But for now, let's see if that lower peak in bond prices manifests and we continue to go lower. This is a great chart to watch because if we would break that pattern, that could tell us we're in a different environment with stronger bond prices and maybe weaker yields or lower yields in the short term. All right, looking at the chart of Bitcoin, I mentioned how many charts right now are kind of in a sideways phase. I think you could argue that for the S&P and the NASDAQ, certainly for NVIDIA, semiconductors, kind of that sideways rectangular shape on the chart. I think Bitcoin is in one of those as well. You know, Bitcoin over 108,000 would clear the way above a key resistance level for the last 2 months. Bitcoin below 92,000 would clear support level, right? Would break below a valid support level that's been in place really since around Thanksgiving of last year. So we find ourselves sort of in this range, right? And I think at this point, you either have a way to play within the range and do more of a swing trading mentality to sell strength and buy weakness and sort of bet on that mean reversion, or you wait to see which way we break out of here. Again, I think Bitcoin over 108,000 is a pretty bullish chart because that would clear the resistance, suggest that this consolidation phase is now over, and we break down. The risk to that thesis would be a break below 92,000. Also watch the momentum, which has been kind of neutral, right? Below 60, above 40. Wait to see which way we break. Wait to see the momentum accelerate in one direction or the other, and then I think that would be the signal to wait for. For now, I think the chart of Bitcoin is neutral. It's telling you to hold on and wait for that signal to emerge. I mentioned NVIDIA as of today, finally sort of getting back within that gap range. On Thursday and Friday, we did sort of test the lower end of that DeepSeek gap. Today, we're actually going very clearly back within this range. So NVIDIA has essentially erased, some of those gains. About 50% of that gap from the DeepSeek Monday has now been eliminated. But the bad news is for bulls that we're kind of back into this consolidation phase. So you count that a breakout. We drifted a little bit further. Now the breakdown has been negated because we're back within this range. I think getting back above that support, that resistance now becomes support. 132, 130 will be the lower end of this trading range. On the upside, it's 150. Look how many times we tested that level. Famously here in early January, getting a big bearish engulfing pattern, which led to further deterioration. We had another one as we retested that 150 level in mid-January. So the SMH, NVIDIA, and other semiconductors have been really have often had bearish candle patterns as they test resistance. I would remind you that as you watch the chart of NVIDIA and see if we make further progress within this range. I promise to keep Alphabet kind of handy as we track the gap lower last week after an earnings miss. Again, up until that earnings day, Alphabet looked like a pretty good chart from a technical perspective, making new highs, pushing above $200, getting out of that consolidation phase. But we gapped lower to the lower end. As of Friday, we traded a little bit lower. It kind of remained within Friday's range today, but I think overall the damage done here. I think this is a chart that's more broken than anything. I would assume that this is a chart going lower until proven otherwise. But it's not end of the world bad just yet, right? After Friday's sell-off today, the momentum kind of holding steady with an RSI around 40, but certainly an active chart to be watching. I wouldn't blame you if you'd sort of lightened up. If you own Alphabet and you lightened up a little bit based on that initial breakdown, I don't have a problem with that. I think that's good money management because there's certainly potential to go even further there. All right, we'll finish with a couple random names, and then I see plenty of questions that we should be able to answer here, a question or two before the end of the show. SMCI, just interesting chart, could be an inverted head and shoulders bottoming pattern, or here's your technical analysis trivia of the day. Another name is the Buddha bottom. For some reason, that's one of the reasons why it's known. An inverted head and shoulders. You've got the head, higher shoulders on the left and the right side. This is really more of a complex inverted head and shoulders, I guess, where you have multiple right shoulders and multiple left shoulders. In any case, you take the neckline, which would be the swing high in October, the swing high in December, you draw a trend line and you wait for a break, which means SMCI above 45 arguably completes that inverted head and shoulders bottoming pattern, and would suggest essentially a retest of the previous highs if you take the height of the pattern and project it, which is a significant upside objective given that given the height of the pattern. But I mean, this pattern is a huge pattern, right? From around $50 a share down to around $17 a share on an adjusted basis. I mean, that's a big wide range, which means you're going to get a crazy upside target if that range is complete or if that pattern's completed. So SMCI above 45 arguably completes that bottoming pattern. Two more I wanted to talk through with you here very briefly. Rocket Companies, RKT. Now, I wanted to highlight this one. This is the daily chart highlighting the PPO giving a buy signal. I saw some PPO buy signals back here and saw like kind of a random one here in late November, but then we ended up getting another sell signal soon after. We finally got the buy signal again there. But what I wanted to highlight is sometimes with indicators like PPO, if you feel like you're getting false signals, you can sort of qualify those by waiting for some other confirmation. Here, I'm actually looking for the RSI breaking above 50 as a sign that that bottoming signal is more valid, right? So if you see like this one right here, the RSI never really got much above 40. So it was telling you, great buy indication, but the momentum not really improving at all. That changed here second week in January. We finally get the RSI above 50, and we've drifted higher since then. You could argue the same kind of thing happened back here, right? We had a buy signal in early October. We ended up making a new low, but if you wait for the RSI to push above 50, that's sort of the sign that, yeah, the momentum is actually kind of following through. So a chart like this, when I've seen some false signals and waited for confirmation, that sort of gives me confidence that I want to do something similar here. Some parallels potentially between the fourth quarter of 23 and what we're observing here in Q1 of 2025. Finally, and not to finish on a down note, but Decker's breaking down. I actually did an article earlier today on stock charts talking about endowment bias, which is one of those annoying behavioral biases where the chart starts to look bad, but you still hold on to your position, your losing position, basically because of an emotional attachment to the position, to be honest with you, is what your brain is doing, but you're ignoring clear technical evidence. I want to show this chart of Decker's because I would argue that the uptrend is broken. And look at all the things that we've learned in the last week and a half that have changed the configuration. Now, number one, we made that new all-time high in late January on weaker momentum. That's that bearish momentum divergence. This is what again, is top of mind for me as I'm looking at charts like Synchrony Financial, which I showed earlier. Higher highs on weaker momentum is usually not a good sign. That suggests we're at the later stages. Then we gapped lower here on earnings end of January. But here's the biggest problem, right? We gap down on earnings. We trade a lot lower through the course of the day, but then we continue to go down. So instead of a gap lower and a bunch of buyers coming in thrilled to own Decker's at a quick discount, it's like having a coupon for $40 off the stock, and you see the price go higher. That did not happen here. We actually gapped down and then continued to drift lower, with today the stock down another 4%. So when a stock misses earnings, you have that initial sort of revaluation lower, but then the buyers don't come in. That, for me, is a huge red flag because it tells you that there's just not a lot of optimism left. And people are just thrilled to unwind at a loss and just get out of the way of this thing. So again, what's concerning about the markets here in Q1 of 2025, Alphabet, looked a lot like this, and then the earnings missed, now starting to drift lower. Decker is just one other, now below its 200-day moving average after a bunch of successful tests of the 200-day on the way up over the last 18 months. All right. Thanks so much, guys, for watching and for some of these great questions. Let's get here. Let's say 3P Investor. Thanks for watching on YouTube. Thanks for highlighting SMCI, tomorrow's earnings report. I didn't even notice that. Apologies for that. I should have immediately looked up there. I'm sort of done with earnings, I guess, mentally, as we wind down this earnings season. We'll know if your prediction based on inverted head and shoulders pattern will hold true and shoot up 100%, right? And I appreciate your question. Great reminder to your host to always glance up. That's why I have the full quote, as they call it, on stock charts. And I'm always looking here to see when did they report earnings, when did they report earnings next, just so I have those dates in my mind. Even though I'm not an earnings investor, I don't invest primarily in earnings. I'm more of a technically oriented investor. I would argue you have to know when a company is reporting earnings. You have to get a sense of what is causing some of these movements in the price and dig into it. And as I mentioned on SMCI, I think once you have a pattern like that, a potential pattern, it's all about the trigger, which means you break above that, the neckline, as they say, of the pattern. Let's see. Akira, thank you so much for watching on YouTube. You said gold performed better than the S&P in 2024. You are 100% right. Also outperforming the S&P in 2025 so far. What are your thoughts of gold going forward in 2025? So full disclosure, I do own the GLD. I also own IAU at this point. So I've been adding to a gold position here early days of 2025, just continuing to build on the trends that have gone higher. I'll show you this chart from my monthly chart review because I did that with my premium members at Market Misbehavior last week. And this is one of the charts that stood out to me. Yeah, we do this one, right? So this is year-to-date returns. Now, the labels are a little off because I haven't updated this, but basically, here's gold year-to-date as of today's close. GLD up 10.8%. Bitcoin up 4.4%. Here's the NASDAQ and the S&P up about 3.5%. Small caps up 2.7%. Bonds up 2.3%. That's your leaderboard, year to date. So, again, already you've seen, while Bitcoin was outperforming, sort of mid-late January, gold has sort of retaken that primary role. So, when I'm looking at the chart of GLD, I mean, my general assessment is innocent until proven guilty. This is a chart making higher highs and higher lows. We're above two upward sloping moving averages. The relative strength is improving. The momentum has certainly accelerated. The RSI is above 70, which means I'd probably expect some sort of pullback, but overall that primary trend is still very much there. Anytime you see this, remember that big overbought conditions can often happen earlier in a rally phase. And while that often means there's a bit of a pullback coming, it doesn't change the primary trend because markets usually only become overbought in bullish phases, right? And that's what we talk about. The whole range of the RSI drifts higher in a bullish phase. The whole range of the RSI drifts lower in bearish phases. So when a chart like this is overbought, it kind of tells me two things. Number one, it validates the fact that the long-term trend is probably still up. Number two, tells me to wait for a pullback most likely, because when we come out of that overbought region, that's where you can often get a bit of a tradable pullback, a higher low, and that could give you an opportunity to ride the next leg higher. So overall, I would say the trend in gold remaining quite strong until proven otherwise. But daily, weekly charts all looking pretty strong. That's all the time we have today, folks. We have to wrap up. I do have some other great questions. I'm going to put those in the mailbag. Please make sure you tune in on Friday's episode where we'll get to some of those questions and more. And also, as a reminder, check out the last one, because the last one featured some of your questions, which were really, really well done, and I hope very well answered. Folks, that'll do it for the show today. I want to thank you so much for joining me here on a Monday. Happy February 10th. Again, congrats to the Eagles and Eagles fans. And we'll keep with you all this week as we navigate the remainder of earnings season, as we navigate inflation data and much, much more. For Market Misbehavior, I'm Dave Keller. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.